Welcome back, traders and investors. We have Whitney Tilson on the line with us. Whitney is the founder and managing partner of Kase Capital Management. Whitney, how you doing today?
I'm great. Thanks for having me.
You are fitting right in with the theme that we've had this morning. We've had some people expressing some extreme caution in this market and almost outright bearishness. What's your take on the market today?
Um, with the caveat that I don't consider myself a particularly good market prognosticator, I'm more a bottoms-up stock picker. Look, my portfolio today is about 100 long and approaching 50 short, so I'm 2-to-1 long to short ratio. But my short book is much higher volatility, sort of battleground stocks, richly valued high flyers that I think are due for a fall. So, in practice, it's closer to being, the net exposure is less than 50% if you adjust for the volatility of the stock. So it's fairly cautious positioning out there. And I will say I'm still finding quite a bit more on the short side to do. The new stocks that I'm looking at are still heavily tilted toward the short side. So I guess I'd say cautious but not bearish.
Okay, let's talk about shorting because, really most people don't do it. They are, have all long portfolios, and it takes a different kind of really a mindset to be able to short stocks. And some people just can't get over that, taking that negative attitude. And obviously, you've been in the markets for a long time and shorting. What advice would you give to someone that, is afraid to short the market?
Yes. Well, my first piece of advice is don't do it. It is exceptionally hard. I can give you a dozen good reasons why shorting is a tremendously difficult and dangerous business. And I can show you a lot of scars on my back from a dozen years of doing it myself and learning a lot of lessons the hard way. Being short one Tesla, as I was, can undo a dozen good short positions when you get the occasional moonshot that runs against you, right? So, by the way, I'm no longer short Tesla, and it was one of the biggest mistakes, long or short, of my investing career. But if you are going to short, it's absolutely critical to have a small positions in a well-diversified short book. So my average long position is in the 4 to 5% range. My average short position is only 1%. My largest short position is only 2%, which would be among my smallest long positions. So, because of the risk of running into a buzzsaw like Tesla, it's critical to have much smaller positions, which means you need to have more positions. So, for example, the 3D printing sector, I think, is just an enormous bubble. I think there's some genuine underlying fundamentals behind it, but I think the stocks have become totally disconnected from economic reality. So, but I'm not just short PDD, 3D systems. I'm short Stratasys, I'm short Voxeljet, I'm short Organovo. Until very recently, until the cost to borrow got excessive, I was short X1. I shorted 1% position, not 5% position.
Okay, just going back, to that Tesla trade. Was it something in the technicals that lead you to the short position, or was it just fundamentally you just think that, man, this company can't be worth all this? I mean, they hardly sell any cars. What was it that got you into the position, and what got you out?
Sure. Well, I'm a fundamental value investor, so technicals never play any role in any of my investment decisions. I got into it because the company I thought was going to file for bankruptcy or do a highly, highly dilutive equity offering, be forced to do it as they ran out of money. The company came, I believe, within a matter of weeks of running out of cash. They were burning cash. They hadn't yet launched the Model S. And then, to the company's credit, everything needed to go right for the company. They needed to launch the Model S. It needed to have no quality problems. They needed to ramp production. It needed to be an absolute home run of a car. And when you add up all of those probabilities together, I thought the odds were very low that the company could pull this off. And to their credit, they did. They built a superb car. They ramped production up very rapidly without quality problems, et cetera. Using poker terms, they pulled 3 or 4 inside straights in a row. And hence the stock took off. And so I'm not even sure it was a terrible short at the time I shorted it, within weeks of bankruptcy. Usually that works out pretty well on the short side. My mistake is that not recognizing that once they did get that car launched, once it was getting rave reviews, et cetera, and once the stock took off, not getting out of the way of that freight train.
Okay, you mentioned a very important thing here when it comes to shorting, and it may be something that deters people. You talked about the cost to borrow, and along with that is the locate process. Could you just, explain the cost to borrow and the locate process, and how much of a factor it is when you're choosing a short position?
Right. Well, first of all, to establish a short position, you must find the borrow. You call your broker. In my case, my prime broker is Goldman Sachs. That is my first call. I have a couple others that I use. And they have to short a stock. It's the exact opposite of going long a stock. Instead of buying the stock, you sell the stock. But in order to sell the stock, you first have to borrow it. Your broker will lend it to you. You call them up and you say, hey, I want to short 10,000 shares of X. And they say, we've got the locate, go ahead and execute the short. Then I call my trader. My trader sells 10,000 shares of that stock that day. I collect the cash, but I am obligated to, at some point, to buy back that stock and return it to my broker. So that's the process. And certain stocks, like, for example, 3D Systems right now, it's a big company, and it currently, you cannot get to borrow from anybody. Not a single share of borrow is available of a company that has more than a $5 billion market cap today. And that's because there are a lot of people who see that this company, as I do, agree with my opinion, this company's got real problems and that $5 billion market cap is not sustainable. I would peg intrinsic value of this company closer to $1 billion. So even after falling 50%, I think this stock has 60 to 80% downside, which is why I'm holding on. I was able to get borrow 6 months ago or so when I put the short on. I am not able to get borrow today, and that means that even though I want to increase the size of my short position today, I simply can't. So at that point, I bought some puts. So that's one way of getting around the no borrow problem. The second problem is that the broker might say, hey, I've got 10,000 shares for you of this stock, but it's going to cost you, 10%, 20%, 30%, 40% per year. So it's like a negative dividend that you have to pay a fee to be short the stock. And so, for example, X1, one of my favorite 3D printing shorts, the stock had already fallen by more than 50%. It worked out beautifully as a short. But I get a report every day that tells me what my cost to borrow is on every single stock I'm short. And X1, the cost to borrow was something like 62% annually, which means I've got to have pretty darn high conviction that that stock's going to collapse soon, or else that 62% cost to borrow will just kill me. So I said, you know what? I've made more than 50% on this short. I don't have any opinion when the stock is going to collapse further, though I think it will. I don't have a huge conviction on the timing. I'm not willing to pay the 62% cost to borrow, so I covered my short, and maybe I'll get back in at some other point.
So you do go to the options market if the cost to borrow is prohibitive. You will go to the options markets. Do you
Right.
just go?
It,
Do you just
it's
go?
usually not cost to borrow. It's usually that I simply can't get any stock to borrow at any price. Something like 3D Systems is an example there. But generally what I do is I try and buy sort of deep in the money, long-dated puts if I can, so that effectively I'm just replicating the short position. I'm very, very wary of options. One of my smartest friends once said, Whitney, options are like heroin. They feel so good, but they will kill you. And that generally has been my experience. So I own very few positions via options, because then at that point you not only have to be right on the stock, but you have to be right on the timing. And it's hard enough being right on the stock. It's almost impossible, I find, to be right on both the stock and the timing. So that's why I very rarely use options.
Okay, and if you do, are you just going outright with the puts, or do you try and do anything with spreads, or you just, if you're bullish, you buy calls, if you're bearish, you buy puts?
The latter. I try and keep it super simple,
Okay.
and generally, I'm just trying to replicate either just a straight short or a straight long position.
Okay, so let's talk about, I mean, you definitely have emphasized the 3D printing sector. You talk about the momentum stocks. Is there any other stocks that are on your radar to short or that you're currently in and looking for some more downside?
Yeah, well, look, there are some categories, some
Okay.
baskets, I'd say. I think another basket I'm looking at, and I have some positions in, is just the retail sector, mall-based retailers. The sector's absolutely getting crushed. Every company is reporting terrible numbers, and one of my luckiest, greatest trades ever was Quicksilver. It had been on my radar screen for a while. A couple of days ago, I saw that they were reporting earnings after the close. And so I went and did my work on it, and I saw a company with a terrible balance sheet, declining margins, that was really struggling. Surfing and skateboarding and all are sort of in secular decline. And so I put on a 1% short position. Sure enough, the stock blew up yesterday, was down more than 40%. So that almost never happens. In my entire career, it's hard for me to think of something that I shorted one day and is down more than 40% the next day. But you know what? I'm not covering. It was not a short-term trade. I think this company has serious problems, and I'm not even sure the company today is trading at about six. Its debt level alone is about 6.5 times EBITDA, and I'm not sure the company is worth that. So in other words, I'm not sure how much equity value there is here. So it looks like a short-term trade, but it's really not. I plan to be short it for a while. So I'll just give you a quick example of another company that I'm looking at that reports earnings after the close today. Five Below. The company trades at it's a high flyer. Company trades at 29 times EBITDA, 61 times trailing earnings, 30 plus times this year's earnings estimate. No, 41 times this year's earnings estimates, 31 times next year's earnings estimate. So it's incredibly richly valued by any metric. And by all accounts, it appears to be a well-run company that's growing, et cetera. But I think there's a fundamental permanent shift happening in consumer buying patterns where instead of going to the mall, I've got three daughters, two of them are teenagers, and they are increasingly buying on their smartphones, on their tablets at home. And, my daughter's prom is tomorrow night, and she bought her beautiful, elegant prom shoes from Zappos, for heaven's sakes. So mall traffic is down big, and I don't think it's rebounding. I think there's a permanent shift going on. So, just in general, look for richly valued mall-based retailers or those who sell to them, like Quicksilver's wholesale business. So that would be another theme I'd cite. And then lastly, the alternative energy space. Plug Power, Ballard Power, Fuel Cell just reported terrible numbers yesterday. The stock's down. Let me see where it opened today. Fuel Cell's down. Is down 13% today. It's down to $2, but you know what? I'm not covering that one either. I think the stock goes below $1. So there are plenty of baskets out there of foolishness that the stocks are down 25%, but I think they could be down a lot more.
I'm looking at this chart of this Taubman Centers here. Taubman, a local developer here. I mean, that chart looks pretty healthy here. Are you? Are you playing this one at all in particular from the short side? Or are you playing an ETF or Simon Property Group? Who are you picking on?
Yeah, my largest, I don't, it's not a sector I follow that closely. The only thing I own, and it happens to be my largest long position, is a company called Howard Hughes, which it's a real estate company. They own and are renovating South Street Seaport, for example, for those of you in New York. They own the Woodlands in Houston, Summerlin in Vegas, two master plan communities, and they're developing an enormous project right near Waikiki Beach in Honolulu called Ward Center. Those four properties I just mentioned account for probably 75% of the value. And so it's sort of housing related and playing housing recovery, but they also are building retail, office buildings, apartment buildings right on the beach in Honolulu. And the renovation of South Street Seaport, I think, is going to be a home run. And so there's a lot of exciting things happening. You know, the stock was part of General Growth Properties, all these assets. And then when General Growth Properties came out of bankruptcy, they carved out 34 assets that formed this new company called Howard Hughes. Since then, that was a few years ago, the stock has quadrupled. But incredible things are happening with the company. And so I'm hanging in there.
Okay, and as far as one to play the malls, they have these REITs that pay these just huge dividends. Would that be, one way to to play that sector, shorting the mall REITs?
Yeah, I mean it's an interesting thought. I mean the problem is twofold. One is if you're short it, that means you're in addition to whatever cost to borrow there is, you have to fund the dividends. So if you own the stock, you get paid the dividend. If you're short the stock, you have to pay the dividend. And secondly, these malls have long-term leases. And, I don't think anything like Quicksilver, they're not going bankrupt anytime soon. They're going to keep paying their rent for a good long while. And that means the decline of the cash flows that would come from reduced mall traffic, for example, is going to be slow and gradual. I think a better way to play it is to find the companies like Quicksilver that are just going to report a terrible quarter soon, and you can make a lot more money a lot faster that way.
One important thing that you mentioned, and everyone should take note, is that a lot of these positions, you look for a catalyst, and you have a catalyst like earnings. I mean, you can't really predict what the Wall Street analysts are going to do, but an important way, we've had other guests on that you're looking for a catalyst. So if you're looking to get into an issue, either on the long side or the short side, look for that short-term catalyst, something like earnings, because that will definitely moved the stock. Whitney, we've had a great run in the market. It seems like this market's going to go up forever. What kind of advice would you give for investors today? Let's say let's look at it a couple ways. Someone that's been in the market for a long time and they're nearing retirement and they have all this money on the table, or new investors, younger people that are just starting to have disposable income to invest in the market. What would your advice be for them?
I guess first one of caution in general is picking stocks, trying to beat the market by picking stocks is incredibly difficult. I graduated in the top 5% of my class from Harvard Business School. I've been doing this professionally, running a hedge fund for 15 and a half years, and I'm regularly humbled. So there are so many smart people, not to mention a lot of supercomputers out there scanning every security out there in the market. So in general, for most people, I would suggest, if somebody's got a broken leg, you take them to a doctor, a trained professional to do it. And I think picking stocks is similar. So if you really don't have the expertise and experience and time to do it and do it well and develop an edge somehow, then don't do it at all. And instead put your money in an index fund. Warren Buffett recently said if he when he passes away, the money he's leaving for his wife is going to be 10% in cash and 90% in the Vanguard S&P 500 index fund. Just keep it simple. Don't pay a lot of fees. And if you are going to go out there and pick a few stocks, just think of things like Berkshire Hathaway. I own some AIG. Don't be out there. My entire short book is full of stocks that are being promoted to individual investors. Things like Organovo, just almost laughable, obvious promotions. Unisys, Unilife, excuse me, UNI, that's the ticker. These little, things like Plug Power. There's just an endless Wall Street and the promotion machines out there pumping these absolutely worthless stocks up to billion-dollar market caps or more, and they're sucking in average people who are reading message boards, and they don't understand. They don't have the skills to read a balance sheet, an income statement, a cash flow statement. They can't see that the company is worthless, and they don't realize that the message board posts that they're reading are often paid promotions, designed to pump the stock up. The movie The Wolf of Wall Street with Leonardo DiCaprio this summer about these bucket shops. That movie took place, I don't know, 15 years ago or so. I'm telling you, the exact same stuff is going on today, and a lot of innocent people are being sucked into it.
Okay, good advice there. Just a couple of Momo issues here. A lot of talk about Apple going into the split here. Great earnings. Carl's been talking this one up all the way. Do you have an opinion on that or not?
Yeah, look, if you wanted to have a 10 stock portfolio of blue chip stocks, and you had some Berkshire and some AIG and who knows, some Procter and Gamble or what have you, and you wanted some tech exposure, I wouldn't argue with you if you wanted to put Apple in there. It's a great company. I don't own it, and my concern is a couple fold. One is they have a very high profit margin to defend, and the only way to sustain those very high profit margins is to constantly innovate and come up with must-have products. Things like the iPad and the iPhone. The problem is since Steve Jobs died, and I highly recommend Walter Isaacson's book on him. If you're thinking about investing in a stock, you really have to read that book to understand Steve Jobs and how much that company really relied on him. And since his passing, I haven't been impressed in the slightest with the degree of innovation coming out of Apple. I mean, it's absolutely inconceivable to me that the iPhone still has that tiny little screen, which is what caused me to switch away from the iPhone a number of years ago. I just can't read and type on that tiny little screen. So I actually just a couple of weeks ago bought Samsung. Not a big position, but Samsung is operating on half the margins of Apple, and that may make some people think it's an inferior business. But what that says to me is it doesn't have to defend unsustainably high margins. It has good margins, but just not ridiculously high margins. And the stock is trading at something like 3 times EBITDA. It's drowning in cash. So it has somewhat similar characteristics to Apple. But the stock Apple stock is moderately priced, even I'd say a little on the cheap side. Samsung is the cheapest high quality global big cap stock I'm aware of. It's just insanely cheap at about 7 times earnings and 3.5 times EBITDA, with a very strong balance sheet, and they're number 1 or number 2 in pretty much every category they operate in. So there is no ADR on Samsung, so it only trades in London and in Korea, so that may make it a little tricky for many of the listeners here. But that's I sort of prefer Samsung to Apple.
Okay, we've had Whitney Tilson on. Whitney is the founder and managing partner of Kase Capital Management on Benzinga's Pre-Market Prep, brought to you by Options House, talking about shorting, talking about portfolio management, talking about discipline, all the things that make you a successful, short-term and long-term trader. Whitney, thanks for taking your time out this morning. We'd love to have you on again.
My pleasure.
Okay, thank you.